The more and more that I interact with my clients, as well as other industry professionals, the more I realize that we just continue to say things assuming people understand what we're talking about. And that's why I've created this series. This is part 2 of trying to simplify words that are commonly used in different real estate transactions when buying a home. Hopefully you saw the first part of that. If not, please go back, check it out. And now you can walk with me and watch as I walk down the beautiful streets of my home here, and we talk about the things we say and why does it have to be so hard. So this video will talk more about the terms specifically related to purchase transactions when you're under contract. So let's start right there. What does that mean, under contract? If you're under contract, that means you've submitted an offer to a seller telling them that you want to buy their property, you're going to pay a certain amount, you're going to give them that money on a certain date, and you've agreed upon those terms. They say, yes, we accept that, and you've said, great, I'm going to follow through. So an accepted offer means those terms are in place. Now at this point, hopefully you've worked with someone like our team and you already have a loan approval in place. But if you don't, that's another wonderful term to look at, loan approval. A loan approval means that all income, assets, all the documentation. So basically, I call this the show me the money phase. This is where we look to say, we've looked at your pay stubs. We may look at your tax returns. We want to look at your checking accounts, your savings accounts. If you have other assets like IRAs, retirement accounts, basically where your money is at. What we're looking is to make sure that you have the money that you need for the transaction, basically to repay the loan, and basically to make sure you have enough come that day when you need to qualify and send, or when you have to give that money to the seller, right? So we need to make sure that you have the money for the down payment and those closing costs. So loan approval means that an underwriter's reviewed all your income, all those asset bank statements and those documents, and that there's no longer any conditions. Also included in loan approval can be an appraisal. So why don't we talk about that? An appraisal, now this is one that I always assume everyone knows what an appraisal is, but the reality is that if you're not thinking about this all the time, you probably have no idea what's the difference. What's an appraisal? Isn't that the home inspection? So these are the different terms that we look at. Well, an appraisal, when you're buying a home, is actually for your lender. The appraisal is to tell the lender that that property is sufficient collateral for the loan they're giving you. So basically it means that if you don't pay the money back and they have to take your home, then that property is going to be worth the money they gave you. So although an appraiser is focused on what you're paying for the property, the number one goal is to make sure that that property works based on how much the lender is going to lend you. So that's a term that you'll use. I also said inspection. So an inspection is not like the appraisal, and the fact that the inspection is going to be a third-party inspector that you'll pick that will go through and determine that there's no immediate repairs for the property. Basically determining what needs to be done, if there's anything that you have to consider. Maybe the water heater needs to be replaced, or if it's a brick building and some tuck pointing. There could be other areas of focus that are gonna either require immediate repairs or at least in the not too distant future. So that inspector is going to help you understand, what's this going to cost you to own this home? So both are important depending on your situation, but they're not the same thing. I think that we would fail if we didn't also talk about pre-approval, since we've talked about loan approval. So a pre-approval is a step that most people will take before they actually get out and shop for homes, or at least they should. And this is much like the loan approval. It's basically looking to verify your credit, your income, your checkings, your savings, all that documentation before you have a property. So this will be based off of letting you know what your buying power is. A lot of people don't realize that you can actually use the pre-approval as a great basis to help you figure out the price point. Like, how much should you be looking at? And everyone may want $1 million property, but when it comes down to the loan approval, if you can't buy that property, what good does it do you to get out and look at those properties? So the pre-approval is a way to determine that when you do find a place, you'll have no problem moving forward. We'll give you the money, and then Also, it should be used as a great way to set your budget, to have a better understanding of what you can buy and what that will look like. Something I run into all the time is, what is a conditional approval, right? You've given us your income, you've given us your statements, you've given us everything, right? But yet we come back and say, we have a conditional approval. Well, it's just that. It's an approval that means there's still some things that the lender wants to see in order to say with full confidence, here's your money, we don't require anything else. And that could be an updated pay stub. It could be the appraisal for the property again. There's a number of things that can come up after an underwriter reviews your documents that could lead to more questions. So don't be shocked if the lender asks you for additional documents after you feel like you've given them everything. Something my team does, we do this up front. We review everything, ask for everything while we have the time, because it's frustrating when the clock's ticking and you're worried about getting the results from your home inspection and talking to an attorney or talking to the people that are waiting on you for that timeline, and now you're stressed out trying to figure out why your pay stub has the wrong amount on it. So we like to do that up front, but just know that after you have your approval, if you get what's called a conditional approval, just means there's additional questions. All right then, what's the clear to close, right? Everyone says it's a favorite thing, just looking for that clear to close. A clear to close should mean that the lender does not require any more documentation from you. Everything's been reviewed, approved, signed off, and now come the day of closing or the settlement, whenever you need to sign the documents and provide your proof, there should be nothing else for you to do at that point in time. But let's talk about that. Closing or settlement. You're going to hear different terms depending on what state you're in, wherever you're watching this and what that looks like. But the closing is basically the day when this is where everything comes down to, right? This is what we've all been waiting for. This is what we're looking for. And that's the day when everything's final. When you have a closing or a settlement date, that's the day you're going to show up. You're going to sign all the paperwork that says you've agreed to these terms for the loan if you're using a mortgage or if you're using a loan for that. And it's going to say that you've agreed to give the seller this amount of money. They've agreed to give you their property. Maybe there's additional credits that they're going to give you, but they're going to agree to everything that it takes to walk away from that transaction without any other conditions, without any other requirements. So the closing date is when everything's final. All right, so at the closing then, as I said, this is where you have to give your down payment and the closing costs. What are closing costs, right? Seems simple enough, but maybe it's not. Closing costs are the fees associated with your loan. This is what you have to pay for third-party providers. And there are a lot of costs when it comes to buying a home. It's really expensive outside of your down payment. See if, hopefully I don't get run over while making this video. Although I bet you that'd make a better video. People would find that more interesting. Closing costs are going to be the fees that you pay, say, for an appraisal. Your lender, you're going to pay their fees, and they're going to have different fees. They'll call them underwriting fees, processing fees. It's basically, these are the terms used when it comes down to what does it take to give you that loan and what does it take to get to that closing table that day. When you're closing, you'll close at a title company or an escrow company. They're going to have their fees and their charges and their breakdown. These are all the costs that add up to what you pay outside of your down payment. Another commonly used term that you'll find is escrows or impounds. So basically, when you make your monthly payment for your loan, you may have an account set up to pay your taxes for you and your insurance. This can be called an escrow account. Those deposits can be called impounds. So when you hear about a lender talk about escrow deposits, this means that they're putting money into an account to make sure there's enough money to pay your tax bill when it comes out. This is also going to bring another term, which is called prepaid items. So technically your escrows are not a fee, right? Because you're not being charged. They're just collecting, the lender, by they, are collecting money up front for other items you have to pay for, in this case, property taxes or homeowners insurance. So it's not that a lender is charging you for your taxes. They're collecting that money and you're paying it in advance or prepaid. Prepaid items will be things like your escrow deposit. Also will be interest for the remainder of the month when you close. Interest is the cost of your money. And you'll also then find homeowners insurance can be included in those prepaid items as well. So when you're talking to a lender, they tell you your closing costs are $6,000, and then you get a loan summary and it says you need $10,000. A lot of times it's because of those prepaid items. So make sure you have an understanding of what those items are. It can get confusing real quick. Look, after 22 years of doing this, I still assume everyone knows what I'm talking about. And the reality is, it's not that easy. If you don't deal with this on a daily basis, not everyone looks to buy a home every day. Not everyone is dealing with this every day. And when you're not, that can lead to a very complicated process. At least it seems that way for something that otherwise could be very simple. So hopefully this video helps. If you like it, please remember to follow, like, subscribe, send any questions you have, and we'll continue. Pay attention for part 3 as we continue to try and simplify all these words we use when you're trying to borrow money and buy a home.